it's September the 1st, you give me a rent check, and that's an expense to you. All right, what did that transaction do to your balance sheet? What did it do to your assets when you gave me a check? Cash went down. So cash, which is an asset, cash is an asset, it went down. Do you owe me any more money for September? No, all right. Did you sell me any stock? No. Was it a revenue transaction? Did you sell me a product or provide some service? Is it an expense? Is it a cost of doing business? So when I subtract an expense, what does it do to my net income? So when I subtract these expenses, what does it do to my net income down here? It makes it go down, right? So every time I have an expense, then it makes my retained earnings go down, my stockholders' equity goes down. So a revenue transaction makes assets go up, stockholders' equity go up. What does an expense do? Makes my assets go down and makes my stockholders' equity go down. So when you're looking at your income statement, the way you're going to put revenues on there is you got to perform a service. You got to do the work. And I'm either going to pay you cash or I'm going to promise to pay you cash later. That makes it accounts receivable. It means you're going to receive cash in the future. That means that every time you have a revenue transaction, you also have an asset on the balance sheet. See how all these financial statements are tied together? Right, every time you have an expense, and in accrual-based accounting, the way we have a rule in accounting is most of us do accrual-based accounting, and the rule is if you've done the work, it goes on the income statement. If you owe for the bill, it goes on the income statement. So if you promise to pay the bill later, then that's accounts payable. But every time you owe someone for a bill, that's an expense. So give me 5 different expense accounts. Let's say you open up a store today. What expense accounts are you going to have besides rent expense? Utility expense? Employees. You're going to have a lot for employees because you got salary expense and you got to deduct taxes. So you got Social Security expense, Medicare expense. You got property tax expenses, maybe you got sales tax expenses. It's all the cost of doing business. So revenues minus expenses and the net income. Expenses, if you pay for them in cash, then assets go down and stockholders' equity go down. Now, what if you came, let's see. Let's say that you got your utility bill today, so you got utility expense, but you really don't have the cash, so you're going to pay it next month. So if I put an expense over here and make my expenses go up and my stockholders' equity go down, something else has to happen. Liabilities go up because you owe it. So on an expense, you could have a situation where your liabilities went up and your stockholders' equity went down. Revenue transactions mean that you perform a service. This means you owe someone for a bill. This is your profit. Your statement of retained earnings is your beginning retained earnings plus net income minus dividends. That's going to be your ending retained earnings. Your balance sheet is assets. Name me at least 6 asset accounts besides cash. Accounts receivable.
Inventory.
Inventory. Prepaid expenses. Now, this one usually causes trouble on the first test. Prepaid expenses means that you bought supplies, and you bought like a lot of them that they're going to last you like 3 months or something, or you prepay insurance for like 6 months, or you prepay rent for like 6 months. So if you're prepaying something that's gonna cross over several different months, we call it a prepaid expense. The problem is, instead of paying attention to the prepaid, students that are beginning accounting students, they look at this word expense, and guess where they put it? They put it over here. And then they've messed up their net income and their assets. So it might say salary expense, utility expense, but if it's got the word prepaid in front of it, it better be on the balance sheet, not the income statement. So prepaid is going to be, that's going to be an asset account. Now, let's come up with some other asset accounts. You got land, you got buildings, you got equipment, and in your book, which I don't approve of, they throw in intangibles. Those things that are more like a piece of paper than something that you can touch. All right, so a couple of intangibles might be a patent, a trademark, a franchise. So these are like paper assets. They're in the assets section of the balance sheet, but it's more a piece of paper. It's not like cash that you can touch or inventory that you can touch. So if you were going to have to calculate out of a list of accounts total assets, then you would need to be able to look at those and add up total assets. What they do in all test banks and accounting, if I were going to ask you to add total assets, I might put these accounts in there, and then I'd throw in like capital stock. You'll have to watch me, because in my class, my textbook, instead of calling it capital stock, calls it common stock. Means the same thing. Might throw in retained earnings. So if the question is calculate total assets, what are you supposed to do with the retained earnings in the common stock? Ignore it. So the questions sometimes will give you information that you're supposed to ignore. So just because it's in the list doesn't mean that you have to use it. You can use it, but you know, if you want to get it wrong. So assets are cash, accounts receivable, inventory, prepaid expenses. You got your big ticket items like land, buildings, equipment, and then you've got these weirdos over here, like a piece of paper. Trademark, patent, franchise, copyright. All right, does everyone know what an asset is?